Hello and welcome to Earnings Call. It's that time on the show when we interact with the top management of Wipro. Since this is our first interaction with the top management of Wipro for the fiscal FY13, this interaction is of immense importance given the kind of global and local backdrop we are in. Straight off, let me bring on board the three wise men, D.K. Kodian, Suresh Senapati, Pratik Kumar. Gentlemen, always a delight to be back in the Wipro campus and always a delight to have you back on ET now.
Thank you, Nikunj. Thank you very much.
DK, let's first start with the big picture. Q4, a satisfying quarter. You've managed to protect your margins and you've managed to live up to your guidance.
So quarter four was for us an important quarter because it was a quarter of execution. You know, all that we have messaged in the past and all that we kind of had within, it is really for us, we had to deliver on commitments. So if you look at the numbers, we've always committed that there were two pillars under which our entire strategy was kind of based on. One was customer satisfaction, the other was employee satisfaction. If you look at customer satisfaction, on the top two boxes, our customer satisfaction is up by 20 percentage points. If you look at attrition has remained more or less stable from quarter three to quarter four. On a year-on-year basis, quarter four to quarter four last year to quarter four this year, it is a drop of 6.5%. Pricing is up on-site by 0.4%, which is the highest pricing we have had in 10 quarters. Our offshore pricing is up by 1.4%. Our cash flow as a percentage of profits is 109%. So overall, if you look at the client side, the $100 million customers that we've got, we've moved from 3 last year to 7 this year. On a run rate basis, that number is 9. We have moved our average from 110 million to 123 million in this customer base. So overall, if you ask me, very happy with the results. On the profitability side, again, you can see the numbers. It's down 10 basis points in spite of the fact that between quarter 3 and quarter 4, the decline that we have had in exchange has been close to about 4%. So overall, happy with the quarter.
But if the quarter was satisfying, if I look at the revenue run rate in between quarters, you're growing higher than the industry average, then why such a flat guidance?
It's very simple. It's driven by a couple of parameters, and we don't think quarter one is going to be an indication of the full year. So if you look at the real reason behind that, it's primarily based upon our India business. Our India business, and you know the environment outside, the India business has actually degrown for us in quarter one compared to quarter four in two segments, which are in our belief are going to be stressed for one quarter, but it's not going to be a secular trend. The two areas are going to be telecom and government. Both those areas we see a decline in demand. And we see that coming back in quarter two.
So can I read in between lines here that you will be able to grow higher than the industry average?
So, you know, always, the endeavor is that we don't want to be number 2 in anything. We don't want to be second best. And for us, the game is very clear. Long term, if you look at the way customers are buying from us and from our competition, they're looking for sharp differentiation in the front end and a high degree of standardization in the back.
Will you beat the NASSCOM guidance?
That I'm giving guidance.
But you'll appreciate my curiosity also, because the kind of commentary which we've got from your peers, it's very confusing. So if I have to judge how Wipro stands, how do I judge it?
Very simple. If you look at our pipeline today, nothing that we see in our pipeline makes us believe that the NASSCOM guidance is overstated. Right? So to that extent, we believe that there is a fair opportunity that industry as a whole will grow within that band, and it would be our endeavor to make sure that we grow equal to or ahead of them. It's as simple as that.
That's the punchline I was looking for. Suresh, at a time when US economic growth is coming back, how come that is not translating into real growth when it comes to spending?
I think varieties of surveys, variety of discussions with the customer, you are getting a feedback that the budgets are going to be flattish. So consequently, in a situation, an environment like this, customers are investing in transactions which have an outcome which is much more sustainable, medium to longer term as opposed to shorter term. And that leads by itself into some amount of processing of those proposals, value propositions, what can you do, etc., much more. So when we are in this game of trying to partner with the customers to be able to create demand and therefore promised the customer what is the improved cycle time, what is the simplification, what is the risk management that you are doing, or what is the cost saving that you are achieving for the customer, there is a time which it takes to be able to go through this particular process. So like Kurian said, there is a visibility based on the pipeline that you're seeing, but because many of those deals are also of a proactive nature, it has its time. Because when you talk about an RFP, decision of the customer is there that they want to source it. Then a question of who is differentiating, who is giving better pricing, etc., etc. Here it is not that. Here you are creating a solution and value propositions and sending it to the customer. So it has a little higher lag time. So I suppose why our optimism for the rest of the quarters of the current fiscal is coming from there, that we have a pipeline which looks very good, and there is the confidence that emerges that we should be good for subsequent quarters.
Right. So by and large, Suresh, what you're indicating is that you expect the trajectory to remain upwards. And in terms of margins and in terms of pricing power, you are in a commanding position.
The first one, yes. So far as the pricing is concerned, like we have seen over the years and the quarters, that there is a pretty stability in the pricing environment. There will be certain pockets where you will be seeing certain pressures, etc., etc. But like I said, when more and more transactions are happening in a manner of an end-to-end and a goal to be achieved for the customer as opposed to price that the customer is paying to us, more and more you are playing into the demand generation as opposed to demand fulfillment area, this will become less relevant. And therefore, I would characterize the situation as a stable pricing environment.
What about margins? What's the bias?
In this point in time, we are trying to change the funnel, change the quality of revenue, etc., etc. There are a lot of investments that is happening. If you see our Q4 or the last few quarters, whatever compensation increase we gave in the 1st of June, we have been able to recover through the varieties of process. But there is a front-end differentiation that we are seeking. We are investing a lot in terms of high-profile people, which means more cost, which means more people on-site, more consulting profile kind of people. So, and we have also increased certain capacities, particularly in the data center, and also in some of the new solutions that were coming out with the India Center, and therefore there are a little bit of margin decline there. So net-net, we have been able to hold our margins. In the shorter term, there may be variations, but as we exit the current fiscal, we should be seeking a positive bias in the margins.
So what is positive?
Nikunj, it's very simple. let me just make it very simple. There are a couple of areas where we will not slow down on investments. We will not slow down on investments in solutioning, sales, and marketing, which means that the architecture layer that we have, the program management layer that we have, and the domain layer that we have, we will continue to invest much more in. So in front of the customer, the investment would go up. In the back, our real endeavor would be to get more efficient. And to that extent, I think what you're going to see playing out is the productivity gains that we're going to look for. That's broadly how it's going to pan out. So overall, if you look at the year, we think it's going to move in a narrow band, the margins. When we exit the year, we see a positive bias from where we are today.
Define positive bias for us.
That's difficult to do.
North of the current.
If I could tell you what's going to happen 2 years from down the line, I would be either buying or selling the entire industry.
You've been perfect in predicting your guidance. I'm sure you have a sense there.
We have a sense. We don't guide on profitability. You know the answer to that.
Fair point. Prateek, you must be the happiest man in this room. Utilization rates have gone up. Attrition rates have come down.
Yeah, so it's been, Nikunj, satisfying quarter. We held steady as far as attrition is concerned. And that's pretty much in line with what we spoke about earlier, that there is a greater stability in the organization. You're right, utilization, despite in terms of headcount increases and headcount adds, we have seen that that number, including freshers, has actually gone up. Our gross hiring numbers continue to be fairly good and robust. So if you look at all these parameters, it just indicate that many of the initiatives which we have been working on seem to be falling in place. So that as you heard TK also earlier saying, we also did our employee perception survey, which was done and completed about 3 to 4 months back. And the scores coming out of that was also reasonably positive. So yes, there are quite a few things which augur well.
Do you expect a utilization rate to go beyond 80?
So that would be the highest we have ever actually hit. And, you know, it's debatable one needs to be actually beyond that, especially when you're gearing up for growth going forward. So a good balance which will go up and down depending on intake coming from universities, colleges, people who join. So there could be some dilution in certain quarters. But by and large, in that range is where we would like to maintain.
You've had about 13,000 employees for the last fiscal, which is FY12. What is the number for FY13, Pratik?
So we don't specifically guide on people whom we would be adding. But as I shared with you, our hiring mix is going to be biased towards people who would be joining from colleges and universities. And that's the trend we will continue to maintain.
Salary hike, who wants to answer this question?
So maybe I'll take that. Nikunj, we've always believed, again, it's important as leadership. It's extremely critical that all of us stand up and live our commitments. And to that extent, we messaged last year that our salary increase is going to happen irrespective of anything on the 1st of June. We're going to stick by that date. Because we don't believe that, if you see downturn in the industry or if you see industry forecasts coming down, we should go ahead and cut employee salaries. We think it's completely wrong. And because ultimately we want to be the place where employees really want to come to work every day and feel proud about coming to work. So to that extent, we will give a salary increase on the 1st of June.
What could be the broad range?
So some of our competitors have announced a certain range. We would broadly be in that range. But in certain skill levels, we will be even upwards of that range. Certain skill levels, we would be lower than that range. But for us, it's important that as a basket, we keep within the range that everybody else is.
So just 6 to 8% broadly.
In that range.
So we're still about a month away, right, from the effective date of, so we have still some more work to do. But what TK indicated is broadly in the range it is likely to be.